Good afternoon, everyone, and welcome to IVMF's VetNet webinars. My name is Elvis Avdic, and I'm Post-Program Support Service Advisor here at IVMF. I help our IVMF program graduates with research and connections to help them start or grow their business ventures or careers. And I hope everybody is well during this pandemic. And before we get started, just some ground rules. If you guys have any questions during this webinar for our guest, please make sure that you expand the purple arrow at the bottom right of your screen and enter your questions in the chat box, and I'll make sure that Jonathan hears it. So today our webinar is with one of our IBMF research partners, Gardner Caprelli, CPAs, and I would like to welcome Jonathan. Jonathan, welcome.
Elvis, thanks for having me. Good afternoon, everyone. It's a pleasure speaking with everyone today and sharing my experience. I'd like to thank all of you for your service. It's a great opportunity to present to such a great organization, and it's a pleasure being here today. So just a little bit about myself. Again, my name is John Runge. I have been working in public accounting for about 4 or 5 years now. With majority of my practice being in tax. So I'm gonna share my PowerPoint and we can get started. All right, and let me know, Elvis, does everything look good to start where it should be?
Looks good on my end.
Okay. All right, so here's our agenda for today. So I already told you a little bit about myself, so I'll tell you guys a little bit about our firm, Gardner & Caprelli. We'll discuss paying yourself as owners, your employees, and subcontractors. We'll touch base on some various tax topics, discuss planning for tax time, and finally we'll end with a few CARES Act updates. So about us, so I already told you a little bit about myself. I'm a SUNY Oswego graduate in a master's program with my MBA. I've been working in tax for 4 to 5 years now, and I've been with Gardner & Caprelli for just short of a year now. G&C was founded in 2016 by Matt Gardner and Jim Caprelli, and in 2016 we've grown from the 2 founders to 17 current employees. Majority of our services that we provide is all finance and accounting. Virtual CFO is what we call it, and we pretty much outsource all accounting and finance functions for our clients, as well as providing your typical tax and attestation services. So getting started into the content today, paying owners, employees, and subcontractors. Of course, everyone that gets into business, you know, your goal is to pay yourself. You want to do well for yourself and do well for your community. So when you're paying yourself as an owner, there's a couple things you want to keep in mind depending on the entity structure that you are in. A C corporation pays self through W-2 wages, which are subject to payroll, taxes, withholdings. A S corporation pays self through W-2 wages as well with payroll, tax, withholdings. You also have the option to pay distributions to yourself as an S corporation. However, this is limited to the extent of earnings within the company. A LLC can be taxed as either a partnership or a sole proprietorship. A partnership if you are in business with others, a sole proprietor if you are in business by yourself. These are paid through distributions. No payroll taxes are withheld on your distributions. However, the net earnings that you make are subject to self-employment tax. It's important to keep in mind that if you are structured as a partnership, you should not be on payroll with the company, and you should not be receiving a W-2 for yourself. As well, a LLC taxes a sole proprietor. Again, you are taxed on your net earnings, and these are also subject to self-employment tax. And this is reported on your Schedule C on your personal tax return. Besides paying yourself, you obviously, if you have employees, you have employees to pay. So these are paid via wages with withholdings. It's highly recommended that you use a payroll service provider to simplify the process and ensure that you're staying compliant with both HR and any payroll tax filing requirements. You are required to have both workers' compensation and disability insurance when you have employees on payroll, and you need to issue a W-2 to your employees after year end by January 31st. Domestic subcontractors, again, subcontractors might be someone you're paying throughout the year. If you have professional services being provided for you or anyone coming in and doing work for you and you are not paying them through wages, no taxes are withheld on payments made to subcontractors. It's important to keep in mind that you should be issuing 1099 miscellaneouses to your subcontractors at the following year end if you've paid a subcontractor more than $600 in a calendar year. To alleviate the burden that may be caused by filing 1099s at year end, before paying a subcontractor, you should request a W-9 from them. This will provide you with all of the information you need so that you can file 1099s at the end of the year and stay in compliance and avoid any possibility of paying penalties for failure to file any 1099s. Tax forms and due dates. So this year, with everything that's going on with COVID, this is obviously a one-off scenario that we hope we never see again. Your typical April 15th tax deadline is what everyone is used to for both individuals and C corporations. This year, the individual and C corp deadline is July 15th. The extended deadline, if you are to file an extension for both, are still October 15th. And remember that if you file an extension, this strictly gives you an extended time to file. It does not extend the time for you to pay your tax for the year. If you do not pay your tax by the regular deadline, you are subject to interest and potential penalties. And then S corporations and partnerships due dates are March 15th with an extended due date of September 15th. All right, so taxation of each entity structure. So depending on the structure that your business is in, either it be a C, S corp, LLC taxed as a partnership, or LLC taxed as a sole proprietor, the way that you are taxed changes varying on your entity structure. So as a C corporation, you are taxed at two levels of tax: the corporate tax level and individual tax level. Your income at the corporate tax level is taxed at your net income at a corporate rate of 21%. As an owner of a C corporation, you would also pay tax on your W-2 earnings that you pay yourself throughout the year. You additionally would pay tax on any dividends you distribute from a C corporation, which are taxed at capital gains rates. S corporation, generally this is one of the most favorable that we see in practice between our small and mid-sized businesses. Net earnings are passed through the individual and taxed on the individual tax return, and your income is reported to on a Schedule K-1. You will be taxed also on the wages that you pay yourself throughout the year on your Form W-2, and then in addition, your net earnings for S corporation, again, that is reported on your K-1. A LLC taxed as a partnership. This is also taxed on your individual return. There is no tax at the partnership level. It'll all flow through to you again on a Schedule K-1. And different from a S corporation, your net earnings from a partnership are subject to self-employment taxes. The difference there is that an S corporation, you would be paying self-employment taxes through the wages that you pay yourself throughout the year, where a partnership, you are taking distributions and then paying tax on the net earnings, since the distributions are not considered a deduction. And then an LLC, tax is a sole proprietor. Tax is paid at the individual level as well, and this is reported on your Form Schedule C of your individual tax return. So tax deductions and incentives. So there's just a couple ones that I'd like to point out, really for one, maybe people don't think about and take regularly or know the cumbersome file or requirements for record keeping you might have to keep in mind when doing certain things. So mileage is a great deduction to keep in mind. You may deduct any business miles that you drive throughout the year. The 2020 mileage rate is 57.5 cents per mile. It is very important to keep records throughout the year when you are taking a mileage deduction. And in making sure, if you ever experienced an audit, you want to make sure you're keeping books and records throughout the year and making sure that you're keeping log of all of your business miles driven. Office and home, you may claim a office and home deduction for the portion of your home office that you use for business, and this is essentially taking a proportion of the square footage of the area you use as your home office compared to your entire square footage of your house, and you may deduct things such as your mortgage, your utilities, your repairs, insurance, etc. Again, the simplest way to figure this amount is by doing a simple square footage breakout between the office and the entire square foot of your house. Cell phone, you may deduct the cost to the extent that you use your cell phone for business. And then ordinary and necessary. So I put this on here just to keep in mind that besides these couple that I am pointing out, you may deduct throughout the year any ordinary and necessary business expenses related to your business. The IRS is very vague in words from the IRS, but this is anything that is necessary to help appropriate your trade or business that you may need to keep your trade and business operating effectively. And then finally, de minimis safe harbor election. So you may elect to apply a safe harbor election to your tax return, and this essentially allows you to deduct expenses for things that you may capitalize otherwise. And the number to keep in mind with de minimis is $2,500. So if you have items that you paid over $2,500 for capital improvements or betterments, those are things that you should consider capitalizing, but electing a de minimis safe harbor election will allow you to expense items less than $2,500 in a given calendar year.
Okay, John, on the next slide, we have a question from Rachel. She said, does office in home has a negative consequences when you sell the home? Is that correct?
Yes. So if you take office and home expenses, it is correct. You may have a recapture portion, so that you may have to consider adjusting the basis in the property when you sell it. So there might be a taxable implication of when you have the sale of the home if you do take an office and home deduction throughout the course of the years that you own the property. So that is something to keep in mind when you are taking office and home deduction.
Another question in regards to home office we have from Maria. She's asking, can you claim use of home if you run your business from your apartment, or is it just for those who own their homes?
So, yep, that's a great question. You may also use the office and home deduction for apartments and rent. For that, you do a simple, do an allocation of what you, again, in the kind of ordinary and necessary reasonableness. The portion of the home of the apartment that you're renting that you consider is used for your business compared to your personal living, take a percentage of your rent payments, and this can be used as a home office deduction as well.
Thank you.
All right, so then go on. Relevant tax law changes. So the Tax Cuts and Jobs Act enacted some very large tax law changes that we've seen over the recent couple of years. This changed the corporate tax rate to a flat 20%. Individual rates decreased on average roughly 3%. The TCJA got rid of the domestic productions activity deduction and replaced it with the qualified business income deduction, which equals the lesser of 20% of your qualified business income or 20% of taxable income. Certain provisions may limit this deduction based on your income levels and if your business is considered a specified service trade or business, which is services such as professional services, athletes, consulting, engineering. Services like these face a phase out to a disallowance of the deduction after certain income levels. Entertainment expenses are no longer deductible post Tax Cuts and Jobs Act. This is keep in mind during record keeping when you are expensing meals. So, for example, if you were to go to a sporting event and the portion that you spent on your ticket, you could not deduct this for tax purposes. The meals portion, if you went to the concessions and got meals, this portion can still be potentially percent deductible. So good record keeping and keeping separate records for your entertainment and meals is crucial to keep yourself safe against any potential audit exposure.
Okay, John.
Yep.
We have a question from Tim. He said, can you give an example of the tax that may be required upon selling a property after claiming the home office deduction for several years?
Yep. So example for the tax that may be required upon selling a property after claiming the deduction for several years. So when you sell a real property, you have your basis in the property, which is essentially the value that you purchased property, plus any improvements that you made to the property. If you sell that property for greater than the amount that you purchased the property, that would be considered a taxable gain. If you claim home office deductions, you essentially need to recapture these expenses when you sell the property. So you could potentially have a larger taxable gain when you sell the property if you are taking home office deductions. There is some provisions such as the homeowner's exclusion that you need to keep in mind. So if you own your home for 5 years, you can exclude up to a $250,000 gain on the property. So these are things to keep in mind. But that is at a high level kind of the simplest example to explain in home and office deduction can affect a taxable gain.
Thank you.
Oh, no worries. That's a great question. Thank you. So I talked about entertainment already. So deduction for monthly parking. So owners can no longer deduct the monthly parking for say if you own a place downtown and you have to pay parking expenses, you can no longer deduct those as an owner. So those are now considered a non-deductible expense on your tax return. As well as fringe benefits similar to parking that you pay to your employees. Those are now considered taxable fringe benefits. So those are included in the wage figure that your employees are reporting on their W-2s and pay tax on at the end of the year. The TCJA also suspended the $4,050 personal exemption, and it also increased the standard deduction from the previous, $6,063.50 to $12,200 for single and $24,400 for married filing joint taxpayers. So planning ahead. When you start going into business, you need to consider the entity structure that you're choosing. Either if you were going, for both legal and capital raising and tax purposes. Again, generally between a C Corp, S Corporation, a LLC taxed as a partnership, LLC taxed as a sole proprietor. So evaluating some of the reasons you may choose a certain entity structure. It may be, even though you're going to face two levels of taxation as a C corporation, it may be beneficial to be a C corporation if you are trying to intensively raise capital through issuing stock to potential investors. And as well, in simplicity, it might be best just for you to stay as a single member LLC, taxed at your individual level and filing a Schedule C, and minimize the cost of recording and having to potentially pay someone to file your business tax return. If you're just filing a Schedule C, it might be easier for you to do it a lot yourself and save on some of the costs that are associated with being in a more complex entity structure. It's very important to separate your personal and business expenses. Good idea to always operate a separate bank account, have separate credit cards for each company, and keep everything separate from your personal expenses. Keep books and records throughout the entire year. As a best practice, you should be performing weekly accounting functions and reconcile bank accounts and credit cards on a monthly basis. Maximizing business expenses will obviously result in a lower tax bill, but will also keep in mind your personal cash flow concerns and compare contrast tax savings versus other use of cash. It's not always the most important to try to minimize your tax when you're looking at the grand scheme of things, especially right now, everything we see with COVID. You want to make sure you have cash on hand and you're not always looking at things from a tax perspective. Tax incentive optimization. You could always perform tax planning towards the end of the year, get a rough idea of what your net income looks like. And if you do this around the third quarter, this will give you time to make decisions by year end, say to purchase equipment, which would allow you to have bonus depreciation, reduce your taxable income by purchasing equipment before year end. You can also evaluate wages and consider bonuses. I see another question. That was the same question as well. How useful are apps such as QuickBooks, Self-Employed for preserving records for tax purposes? That's a fantastic question. QuickBooks is the software we actually use in Gardner and Caporelli for our virtual CFO services. QuickBooks is a fantastic tool. It really, through a little bit of training yourself through the material that they have available, you can really gain an understanding. If you don't even have a deep accounting understanding, you can understand just what you should be doing through QuickBooks. You link credit cards and debit cards directly to QuickBooks. So instead of having to maintain these books for yourself, QuickBooks really automates it by pulling in all of the transactions that you're swiping your cards on a day-to-day basis, as well as keeping track of invoicing and payables, receivables, and such. Is there an alternative to QuickBooks that anyone can recommend? What is the best way to record a ledger? Alternatives, you could always do an Excel file, might be a cheaper option. There are other accounting softwares, but I highly recommend that QuickBooks is worth the cost to keep things clean throughout the year. Estimated tax payments. It's very important to make quarterly estimated tax payments to ensure that you are not charged penalties at year end. Estimated tax payments should be made timely. Generally, estimated tax payments are due on 4/15, 15, 9/15, and 1/15. This year, keep in mind with COVID that Q2 estimated tax payments are still actually due on June 15th, even though Q1 payments and your 2019 tax return is not due until 7/15. To figure estimated taxes, you may use the form 1040-ES to figure the amount of these estimates, which is on the IRS website. Another method that you could use to figure your taxes is called the safe harbor method. This amount equals 100% of your previous year's tax. The safe harbor method, if you are a high income taxpayer, quote to the IRS, which is married filing joint adjusted gross income of 150,000, then to meet your safe harbor payment, you must pay 110% of your previous year tax to avoid penalties. You may also pay 90% of your current year income tax liability. However, this method can generally cause possible miscalculations if you are not correctly budgeting or forecasting for your current year. And then finally, I'd like to discuss the CARES Act. With everything that's going on, there's been some very dramatic changes in tax provisions and really everything that's going on right now, and opportunity. And there's things out there that you can keep in mind for cash flow purposes, things that are out there, programs to help small businesses get through everything. So one thing, the retirement plans, a taxpayer can take up to $100,000 early distribution from a retirement plan. Generally, these distributions are subject to a 10% penalty. However, with the CARES Act, this is waiving the penalty if the taxpayer is affected by COVID, either in a financial hardship reason or by physically being diagnosed with the virus. And then these taxes may also be repaid over a 3-year period. The stimulus payment, hopefully majority of people have already gotten theirs, but it's an advanced, it's keep in mind that the stimulus payment is actually it's an advanced tax credit. So if for whatever reason you did not receive your payment and you were eligible to, when you file your 2020 tax return, that $1,200 will be a tax credit that you can claim then. And then the phase out for the stimulus checks, single begins at 75,000, married filing joint 150,000. And then finally, the PPP loan. I want to point out that the application, if you have not already filed for a PPP loan, is June 30th to apply for a new application. High level, the PPP loan, to calculate the amount that you are eligible for, is 2.5 times your monthly payroll costs. The covered period for the loan forgiveness, so to the extent that you accept the loan, you may be eligible for a full forgiveness of the loan, which essentially turns your loan into a grant. And these expenses that you may consider in the calculation for your forgiveness include payroll, mortgage interest, rent, utility payments, and so on. The original period given by the SBA was 8 weeks. That has now been extended to 24 weeks for the covered period that you need to spend those eligible expenses for forgiveness. So we should see a lot more percentage of these loans being fully forgivable than we would have in the past. And then there's also guidance that still needs to be issued to clarify many things from the SBA, but that's a high level of the PPP loan that is available. And strongly recommend everyone looks into that if they haven't already applied or received one, especially with the timeliness of applications being closed off after June 30th. So contacts, again, my name is John Runge. I really appreciate your guys' time today going over some simple tax topics to keep in mind. Matt Gardner and Jim Caparelli are the partners of the firm and co-founders. I have their contact information here as well. We will be sharing these slides, so you have this information and you have my information if you want to follow up with any questions, thoughts, comments, concerns. And again, I want to thank you all for your time, and I'm welcome to any questions that anyone may have.
Thank you, Jonathan. We do have a question from another John. He said earlier there was a mention of 1099s. What happens if your contract outside the U.S.? How do you account for that tax from Ys like Canada or Philippines?
Yep. So if you are a foreign contractor, if you were working with a foreign contractor, you still pay them as is. There is a form. It's not coming to the top of my head. The name of the form, but look it up. There's a form for issuing to foreign contractors. You do need to consider backup withholdings on these payments so that if you pay them, you do have any income tax liability that the IRS isn't losing out on it. So you need to consider potential backup withholdings. But for more information on that, feel free to reach out to me and I can circle back and look into that one for you.
Thank you, Jonathan. And guys, if you have any questions for John, please type it in the chat box, or if you would like, raise your hand and I can allow you to have microphone and video access. So you can ask the John. But John, I do have a question. Probably many entrepreneurs are asking is if the can actually how do you claim a business loss if you have it, or can a small business get a tax refund?
Yep. So a small business, again, depending on the entity structure, let's say you are a S corporation or a partnership, your loss, you would not be getting a refund for your loss. What you would do is your loss would be reported on your individual tax return. This loss would offset any income that you have from other sources. So say you have a job and you're operating a small business on the side and you make $10,000 in wages from your job and your business, you lose $20,000. That'll bring your taxable income down to zero with potential loss forwards. These loss carry forwards can be used to offset future tax. So losses will reduce your taxable income to then either reduce the amount that you owe, or if you have other income from, say, wages, it would reduce your amount of income for then receiving a larger refund from those that already withheld for you.
Thank you, Jonathan. Another question from me is how, in regards to getting a tax attorney for your business, how important is that? Is there a benefit of hiring a tax attorney instead of doing it yourself?
Yep. So generally for your typical filing, you would want to go to either a CPA, an EA, someone with filing experience. This really, more than anything, could alleviate any potential issues that you could run to down the future. The funny thing with the IRS is you can pretty much file your return as you see fit, but that doesn't mean you're doing it correctly. So a lot of times you could file it incorrectly, underreport your tax, overrate your refund, and then 3 years down the road, the IRS comes knocking at your door looking for this tax to be paid back, and then also interest and penalties. and now you have this lump sum amount that you weren't forecasting or budgeting for, that you may have to, get into a scenario that you're trying to either get in a payment plan or get compliant again. So using either a tax preparer, an EA, CPA, or someone with experience, it really alleviates the opportunity for you to make a mistake, and potentially have pretty dire consequences down the road. So generally, if you have a pretty simple return, you're looking at a couple hundred to a couple $1,000 to really have a good peace of mind that you're doing it right. A tax attorney, you wouldn't really pull in unless you had some serious restructuring situations, or some complex situation that a CPA isn't generally seeing, or if you're already kind of in tax debt and you're looking to the IRS to get on some type of plan, and that's maybe where a tax attorney would come in. But generally, you could go to your CPA, EA, or any tax preparation in the area to have a little bit of assurance that you're doing it correctly.
Thank you, Jonathan. We have another question from Chuck. He says, what is the most common or biggest mistake you see single owner or operator startup make?
Yeah, that's a great question. I think the most common mistake that I see is just a lack of bookkeeping and record keeping at the beginning. What happens is you get this idea and you kind of start running with it, and you don't really put through the thought of if I should be keeping things kept separately. So maybe at the beginning you start putting all these things on your personal card, and then you don't have books and records at the end of the year to truly know what you spent. And then at the beginning, all these startup costs, these could be either capitalized and amortized, or they could be expenses you're taking in the current year. But if at the beginning you're running with this idea and not realizing this could turn into a business, and these costs are commingled, it could just kind of turn into a headache and a burden at the beginning.
We have another question from Trashina. What advice would you give to someone wanting to partner with someone and open a business or school overseas?
Um, I I generally, I would have to look into that one, and if you want to reach out to me on an email, I could get back to you. I don't have too much experience with foreign implications of foreign partners, so I would have to get back to you on that one.
Thank you. If you guys have any more questions for Jonathan, please type in the chat box or raise your hand and I can enable your microphone and video capabilities. But this is it from me, John. I just want to say thank you again. It was a pleasure having you. And just to remind everybody out there that we will send out a recorded webinar link with the slides to all that have registered for this webinar. So please look forward to seeing that email come from IBMF alumni. And if you guys don't have questions, Jonathan, thank you again. And our next webinars will be with the ARP co-hosting on marketing and branding. So that's June 25th at noon. So please register if you haven't.
Thank you, everyone. I appreciate everyone's time, and thank you again, Elvis. It was a pleasure.
So we have before we go, we have another question. Transition from being a sole proprietor to an S corp or LLC a difficult one? What prep work needs to go into that shift?
Yep. Nope. That's it's not too difficult whatsoever. You need to file an S election to be established as an S corporation, and this is something that it's done through a form for the IRS to recognize you as an S corporation. You just need to have eligible members. You can't have any preferred stock, less than 100 shareholders. There's just a couple kind of basic guidelines that you could find online, but it's really not too cumbersome whatsoever.
Thank you, Jonathan. And thank you everyone for tuning in. If you don't have any questions, we'll see you next time.
All right, thank you.
Thank you and see you next time.